Well, to talk more about the RBI governor, he did allude to the fact that cuts and hikes in the past have preceded the US actions, and policy is primarily determined by domestic circumstances, and any rate action is going to be determined by the inflation trajectory. So that was the larger picture coming in from the RBI governor. Neeraj Gambhir, who is the group executive and head treasury at Axis Bank, Ashhish Vaidya, MD and head of treasury at DBS Bank, and Soumya Ghosh, the group chief economic advisor at SBI, is joining. They're all joining in to discuss the policy with us. Well, Soumya, I'm going to start with you. What was your overall takeaway from the policy? The RBI governor himself said that it was largely in line with what the market expected.
Yeah, thank you, Ekta. Now, I think the monetary policy was on expected lines. The growth projections at 7% for next year. As you know, that the last year we started with a 6.5% projection, but ending the year possibly with an 8% growth rate. So possibly the growth numbers for 7% for next year could be a little bit on the lower side. If you compare the forecast which has been given in the MPI report in terms of the professional forecasters, also in terms of the savings and investment numbers. So that is one thing. The second important point is that I think the RBI communication as usual is very nuanced, pragmatic, and is guiding the markets in terms of the overall expectations. And I think one of the possible policy, I'll not call it a surprise, but I think one of the policy measures which is also a pleasant surprise to the market, it could be a surprise to the markets, is the review of the LCR norm, because as you know, the governor has been pointing out that the liquidity management is going to be the most important and challenging task, continue to remain in the next year also. And in this context, the review of the LCR norms and other things could actually please the market in terms of being more attuned to what the RBI is supposed to do. So overall, it's a good policy. The numbers are in line with the market expectations, no surprises, and it was expected as usual.
Okay, all right. Well, Neeraj, there's been a tad bit of an up move which has taken place in the 10-year. Nothing really to write home about. It's moved, say, from around 7.10 to 7.13. What is the bond market making of this policy?
Well, I think in my view, even though there's nothing surprising in this policy, pretty much along the expected lines, but in some senses, the timing of any possible rate cut becomes quite uncertain, right? The uncertainty starts with when Fed is going to do it. The market's broad assumption was that RBI will be moving, if at all, after Fed has moved. Now, the Fed's timing is uncertain, and hence, given the commentary around the growth and given the commentary around inflation, even Reserve Bank's timing looks quite uncertain. So I think there is some bit of that realization which is dawning in, which is what is leading to the uptick in the yields, and also the fact that we are in April now. The government borrowing program has started in the earnest. Today is the first auction. So I think market is again creating some kind of a space for new supply to hit in this quarter.
Okay. Well, Ashhish, what in your sense is the bond market factoring in when it comes to the first rate cut from the RBI? And to be, to be correct, the RBI did mention rate action based on what we are expecting from inflation. But in any case, the possibility of a rate cut.
See, for now, given where the markets are trading, I think the bond markets are probably looking at cuts starting beyond October or beyond. I think, but it's very important to understand the drivers which he has mentioned, which is basically the last mile of inflation is the most difficult one. And also the fact that the global commodity prices have been on the upswing in the last few weeks and months. The risk to food inflation. So like Neeraj mentioned, I think the uncertainty has actually increased while the markets globally as well as in India were positioning for a rate cut sometime during mid or third quarter of the calendar 2024. That's sort of becoming uncertain, and that's the exact reason why the markets have probably given up some a two odd basis point on 10-year. But broadly, I think it's a range, and I think we are just still at status quo. We will have to look at how the macro numbers pan out and then take the cues. So there is no certainty in the markets. But clearly, from a macroeconomic sense, we are at the top end of the interest rate cycle. So the market will always be looking out for cues as to when exactly the RBI starts to cut rates.
Okay, all right, absolutely. Well, Soumya, coming to you on that, the big surprise was there was no change in terms of the GDP forecast for FY25, which stays at 7%. Was there an expectation from your side that there would be a change, and how would you read this status quo?
No, I think the governor has already said in one of the press conferences that growth rate this year could be close to 8%. You just have to wait for 2 months. I think on May 31st, you will know the number for last year. So from that perspective, I think it was best to make any revisions to the forecast in the MPR report, because I think we are too close to that date. So obviously the final figures will be out in 2 months. So there is no point in revising the numbers again. What I mentioned at the beginning of the show, I think that possibly the projections for FY25 could see some sort of a change as the year progresses, given the fact that numbers and everything all continues to be quite strong at this point of time. Maybe just that the Reserve Bank wants to get the elections over and then the new dispensation takes power and then look into the numbers in a more holistic manner.
Okay, all right, fair enough. That point is taken. Pranjul Bhandari joins in she's the Group Economic she's the Chief India Economist at HSBC, who joins in to discuss the policy with us as well. Pranjul, hi, welcome to the show. Inline policy, what were your key takeaways?
Yeah, thank you for having me. I think while it looks very hawkish on the outset, I think actually the RBI was able to strike a very fine balance. It sounded hawkish today, which was needed because vegetable prices, protein prices are up. Oil prices have risen 10% in the last quarter. Real rates don't seem too regressive because credit growth is strong. A lot of liquidity easing has already happened. So there was no reason to sound dovish today. But at the same time, in the MPR that was released alongside, it gave a very clear indication that 1 year hence in FY26, it actually expects inflation to fall to 4%. It expects growth to stabilize at 7%. And then, because real rates are always with 1 year hence inflation, it actually signaled that at some point it will find some space to cut rates. So I think that's why it was a fine balance. Hawkish today because there are a lot of pressures out there, geopolitics and so on and so forth. But yet, once the Fed starts cutting, then at some point the RBI will also find that space. And I think that was clear in the MPR. So I would say I would look beneath the surface and call it a little more balanced rather than outright hawkish.
Okay, a little more balanced than outright hawkish. But Pranjul, what is your sense in terms of growth and the fact that the GDP forecast was stagnant at 7% for FY25?
Well, look, it's not that I was expecting them to increase it from where it is already. We know that the last quarter GDP data we got, there was this big difference between GDP and GVA. And we know a few reasons that, there were a lot of changes in the subsidy bill for fertilizers. But we really have to see where all of this goes. Because remember, GDP will now have to grapple with a higher base, whereas we are not sure where GVA will be. So I think with so many uncertainties, many of them statistical, I think it was a good idea for the RBI to not really change any numbers at this point of time. Having said that, I must also say that growth remains strong. In fact, I would argue stronger than where it was at the end of 2023. End of 2023, towards the end, we had seen all the PMIs had started softening. But now, Jan, Feb, March, all of the PMIs have started rising quite a lot. And we're also seeing signs, which I think even the RBI governor spoke today, that rural demand is rising a little bit. If you look at, the Jan Dhan, the deposit cash balances or remittances from urban to rural India, there is some sort of increase in consumption in rural and informal sector. But I would say we have to wait for the statistical issues to get ironed out before the RBI changes any of its growth forecasts.
Okay, all right. That point is taken. Well, Neeraj, coming to you, what is your sense in terms of what the market is expecting when it comes to inflation? Because we have a couple of variables, vegetable prices, Brent crude, which is now at over $90 per barrel. And then we have the monsoon as well to wait for, not to mention the heat wave. But your sense in terms of what the inflation trajectory could be?
So I think, inflation is a story of two halves. The first half is the fact that core inflation actually has been on a sustained, reduction path for almost 9 months now. And we've seen over these 9 months, the core inflation come down by roughly 250 basis points. And it's much below 4%. So I think from that perspective, there is a very strong comfort that you can draw around inflation. The issue, as the governor has also been pointing out, is in the food and some of the other volatile components. It's very hard to forecast as to how these components will play out. There are many supply side issues that can hit these components. But the only comment that I would like to make is that if we see sustained disinflation in any of these components over 2 or 3 months period, then the amount of space that is available for the monetary policy to ease up can open pretty quickly, because the core inflation continues to be in a very, very good spot. So I think the forecast on inflation, as far as our economics team is concerned, is very close to what Reserve Bank has forecasted, around 4.5%. But I think the downward revision on that can happen in a very short period of time if the volatile components of inflation, play or behave well at any point in time.
Okay, all right. Well, Ashhish, one of the key points was that, which the RBI governor did mention during the policy conference, was that the policy will be primarily determined by domestic circumstances and not really what the Fed is going to do. And, in past instances, we've in fact preceded the Fed. Do you now think that we could probably not follow what the Fed is doing and maybe completely not determined, it won't be determined by, say, the first Fed rate cut, which is estimated in June?
So the way I look at from what the governor has stated is obviously the primary drivers are the domestic issues and the way the domestic economy is shaping up. But having said that, I think we are a subset of the global economy, and there are moving parts in the world. So we will obviously look at those as well. Maybe those are not the driving factors. But clearly, the local inflation, the local growth dynamics will take the center stage. And I think that's really what he is hinting. Let me give you another nuanced answer to this. So the bond market participants and equity market participants will always be talking about rate cuts because it suits them, right? But the real economy actually needs to get affected, and growth needs to actually suffer. And in terms of real rates being significantly or basically denting the growth. Till that it doesn't happen, I think RBI is looking more at the economy in a holistic manner. So it's not just about bond market or liquidity market participants, it's actually about what the economy is doing. And I think economy is doing absolutely fine. So there is no hurry for a rate cut. And that's what, to my mind, RBI is hinting at.
Okay. Well, Soumya, what is your sense in terms of hitting that 4.5% mark when it comes to inflation?
No, I think in terms of inflation also, we are pretty at this point of time for an 4.5% target. In fact, these inflation projections with RBI has built up over time could see it could even be lower than that one. And in the first 6 months, you will actually see the inflation coming up because of several other impacts. And July, August could be the months where the inflation could be closer to lower than 4%. So from that point of view, I think the inflation numbers are well anchored, and the markets are also well anchored in terms of a lower inflation trajectory throughout the year. So 4.5% to me looks a very reasonable target at this point of time.
Well, what is your sense, Pranjul, what is the house estimate for Brent crude, and what can we expect on, say, the commodity front, which could probably weigh on inflation?
Yeah, it's been very obviously volatile, but we do expect it to be closer to about $80 a barrel, going forward. So hopefully a little softer than where it is right now. But I think to your earlier question of the impact of all of this on monetary policy, look, my sense is that one of the reasons why core inflation has been so low is because commodity prices fell so much. And the PMI shows it very nicely. I think through the last year, PMI manufacturing shows that producers were able to cut output prices while still maintaining their profit margin because input prices, commodity prices fell so much. So I think commodity prices falling was a big part of core inflation falling. And now if commodity prices are going to stop falling or perhaps be slightly higher than what was anticipated below, I think this is something that we can't completely dismiss. I think it's something we'll have to bake in and follow very closely. But having said that, on your other question on Fed and the RBI, a few months ago, we were thinking that as soon as the Fed cuts, the RBI will cut too, in line with many other EMs. But it now seems that RBI is not in any hurry to cut. It follows its own domestic path, which you also mentioned, of getting closer to 4% sustainably before it starts cutting. So now my sense is that even if the Fed goes ahead and cuts in June, which is our house forecast, we may not see the RBI cut as early as June. It could be earliest August, or a little later. And I think that time is a little opportune for India, because by then the election uncertainty will be behind us. By then we'll have a good sense of how the Kharif plot is looking. And we'll also have a good sense of how the bond inflows, a lot of which is likely to come in June, how that impacted liquidity and need for monetary policy easing. So I think August or beyond, even a bit later than when Fed cuts.
Okay, interesting. So that point is taken that maybe the RBI is probably not going to act as soon as the Fed acts, and that was the expectation earlier. So maybe they could probably start cutting August onwards. And yes, a lot of the triggers would be out of the way by then. But Mr. Neeraj, Gambhir, as well as Ashhish, Vaidya, Soumya, as well as Pranjul, thank you very much for joining in this afternoon and taking us through the RBI policy. It is the first policy of FY25. It is a policy where there has been a status quo in terms of rates for the 7th consecutive meeting. And in fact, rates have been status quo now since April of 2023. Well, we need to take a short break, but a lot more on the markets, a lot more on the RBI policy once we're back. Stay tuned.